Hello everyone, welcome to the part of course which will deal with the fundamental analysis. Fundamental analysis is an important tool in determining the overall direction of the movement of exchange rates. Its importance is critical to the long-term strategies of trading. Participants in the foreign exchange market, which trade is based on fundamental analysis, at the same time perform an evaluation of economic indicators, political environment, as well as other macroeconomic factors. These factors are related to the countries whose currencies are traded and also on the countries that have a significant impact on the entire financial market, such as, for example, countries which are big manufacturers and exporters of oil, gold, and other commodities. The factors of fundamental analysis can be divided into factors that can predict and unpredictable factors. Unpredictable factors are factors which have a fast and great impact on the movement of the currency pairs. In these factors, we can cite political situation, military events, terrorist attacks, natural disasters such as earthquakes, floods, fire, tsunami, and others. Factors that cannot be predicted are characterized by the inability to define the time of their occurrence and also a degree of influence of these factors. An example of the influence of unpredictable factors is the tsunami that hit Japan in 2011 year and caused extremely large human and material damage. The price of the Japanese yen made large increase compared to the US dollar in the next few days. Reason for the increase of the Japanese yen was in the fact that the insurance company started to buy yen to do the reimbursement caused by damage, which led to disruption of the movement of the Japanese currency. Predictable factors include information that is published regularly during the day and which schedule is known in advance. This group of news includes information such as the statement on monetary policy, information about interest rate, data related to inflation, the unemployment, etc. The most powerful influence of predictable factors on the market has a monetary policy that central banks carry out in order to regulate economic activities. Monetary policy is a set of measures and activities that state authorities are taking in order to regulate the money supply. It binds to itself the financial policy because the implementation of monetary policy requires a strong and regulated financial system. The goal of each monetary policy are achieving certain economic effects. There are two groups of objectives, and those are development goals and stabilization goals. Development goals include specific measures and techniques in order to develop the economy. When the country carries out these measures, we can say that it leads the expansive monetary policy. Stabilization goals, they are based on measurements and instruments that are applied in order to stabilize the economy. When the governments are implementing these measures, we can say that it leads a restrictive monetary policy. Implementation of the expansive monetary policy is found in economic systems that have a tendency to decline, or in those economic where, for example, there is rising unemployment, decreasing gross domestic product, the recession, etc. In such situations, the aim of the government and the central bank is boosting the economy and coming out from recession. These results are usually achieved with a cutting off the main interest rate by increasing the volume of loans to economy and the population and reducing the rate of required bank reserves. Restrictive monetary policy is characterized by limiting the demand for money and bank loans by monetary authorities. Restrictive policy is the policy of expensive money and difficult credit conditions. This applies in situations where the demand is bigger than the supply, where there is a risk of price increases, which means a rise of inflation. The most common instruments are increase of the main interest rate, increase the rate of required reserves, and restriction of credit for economy. National banks of different countries have a different goal. At different goals applies different macroeconomic measures that governments are undertaking in order to stabilize the economy. For example, the basic objective of the European National Bank is price stability within the limits of around 2% of inflation. When it comes to the United States of America, as the first and the strongest economy in the world, the objectives of the Fed as a National Bank of America are the minimum employment and price stability. The National Bank of Japan seeks to achieve low inflation rate. The economy of Japan is marked with the deflation factors, which reduces the value of the domestic currency. By understanding the monetary policy, we acquire insight about the long-term direction of movement of certain currency. As for the currencies in Forex market are paired, of course it's not enough to look at the monetary policy only of the base currency in the pair, but we have to follow the monetary policy of both currencies. For example, if we want to get into a long-term position in the currency pair Euro-US dollar, we'd have to study what kind of monetary policy leads the European Union and the United States. A few years ago, the European Union started to implement an expansionary monetary policy because it was in big recession in order to improve economic activity. The European Union wants to achieve this goal by cutting off the base interest rate, which is causing a decline in value of the euro. A cheaper euro causes the lower price of the goods exported European Union, and the result of these measures are increasing competitiveness of products from Europe. At the same time, the US was in economic expansion. The National Bank of the United States was reducing the purchase of bonds in the market from month to month until it was abolished. Unemployment has been reduced to a level below 6%, so the Fed has even raised its base interest rate. These indicators clearly indicate that the European Union economy is in decline, while the US economy is in expansion. All these have reflection on the stock market, and the euro fell compared to the dollar by 25% in 2014 when they started with aggressive expansion politics.